Good afternoon, good morning, and good evening to one and all. This is the Smoking Barrel. I'm Rustin Edwards, based in Switzerland, with my illustrious tropical clothed cohort, Mr. Matt Stanley, based in the hot, humid, dry Dubai.
Not dry, very humid. Good morning, good evening, and good afternoon, whoever's watching. Yeah, look, I realised that I need a wardrobe assistant because I think I've worn this shirt so many times now. I offer no apologies. This isn't a fashion podcast. You tuned into the wrong one if you have. This is your favourite energy podcast. But yeah, the mercury in Dubai hit 68 on the heat index yesterday.
Ooh, hot, hot, hot.
I like a steak cooked medium rare, which is 135 Fahrenheit. I would have been overcooking steak if I left it outside on the patio
That
yesterday.
would be
So,
a very interesting experiment. Throw a T-bone out there and see what happens.
well, I don't know how long it would take, but I'm pretty sure actually we might be onto something there. Cooking in the desert with your tropical smoking barrel host. No, look, shock horror. It's hot in the Middle East in July. Like, why am I surprised? It's humid, it's hot, but it's fine. We're in an air-conditioned house. And I'm talking to you, my good friend, and I'm talking to the TSB Nation. So we lost in the final. Okay. I wasn't, I watched, stayed up and watched it. I'm quite pleased it's over because every game was finishing at 1:30 in the morning and I'm getting on. So I struggled. But yes, $85.75 on Brent. We are 85 holding strong, Edwards.
Well, I don't know if I'd call it holding strong. It was a rally from yesterday. We had a big drawdown in U.S. crude oil stocks, down about over 4 million barrels. But the big headline, I think, yesterday was the intervention by the Japanese central bank on the yen, pushing the U.S. dollar down, 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 down. The U.S.
Yeah.
dollar got slammed yesterday, and it still looks like it's suffering from weakness here today. U.S. dollar, Great British Pound at over 130, which I
Yeah.
think hasn't seen those levels for better part of 6 months. 109 versus the yen, and or I'm sorry, 109 versus the euro, and about under 156 of the yen. So definitely there was some intervention against the U.S. dollar yesterday, helping support crude prices.
Yep. I mean, look, it's a crucial, well, it's a psychological level that 130. You know, when I'm sending money back to the UK, here as I do, um, the dollar dirham is pegged. So when cable moves, obviously sterling dirham moves with it. So I want a stronger dollar as possible. But, I can live with, when I first moved here, I think it was $2.20 to the pound. So, it's a lot better then, but I don't know. It's a psychological level. But you're right. I mean, we touched down to $83.43 yesterday before we closed up at 85.08. So it was quite the rally, up $1.50 on the end yesterday. And I think you're right. I think it's a couple of things. Like we said, thick of summer. It's fairly thin. Lots of people are on holiday or preparing to go on holiday, wherever they're going to end up. And like you said, crude stocks, demand I'd argue it's erring more on the bearish side right now. I was quite surprised we wouldn't see, you know, $80, something like that on Brent, with the China story coming out. That's never good for the bulls, that.
Well, I mean, I think that's not been good for the Bulls. I think the issue that the Bulls have probably latched onto is the wildfires up in Alberta, Canada. There's a lot of fires that have broken up and starting to now impact oil sands production, which is then going to put some concern on either supplies on the TMX pipeline or supplies into the U.S. Gulf Coast. I mean, if you look at the WTI Brent spreads, those have come in massively yesterday, with WTI rallying massively. I mean, you've got $1.50 backwardation on TI,
Yeah.
and about $1.10 on Brent. And I think this is all just accumulation of risk of supply more than anything else, and not spikes in demand.
Yeah. I
Um,
mean, Sepot Brent's trading at $1.15 this morning.
yeah, and
That
that was
is,
trading at 93 cents first thing in the morning yesterday. So you've had this
wow.
big move upwards, and I think these wildfires and the impact on potential production out of Canada is probably the biggest driver. Because as you said, Chinese oil demand is not there. It's not there in the strength that everybody was hoping to see, which would drive the 2.2 million narrative of demand growth that OPEC's been spitting out.
Yeah. I know, I think it was the IMF who came out yesterday or 2 days ago, maybe, and actually downgraded their outlook for Saudi Arabia on the back of purely on the back of the production cuts have been maintained throughout the course of the year. I think they've got them growing. I can't remember the figure now, but they dropped it quite significantly. And Saudi has been one of the biggest growing economies in the world right now. Huge construction budgets, massive giga projects. Aramco listing. There was some shares that were sold, I think, a couple of weeks ago for about 13 billion. Using leverage against funding these giga projects. So a downgrade on growth is pretty brutal, not just for Saudi but for the region as well. So.
Well, I mean, a lot of the mega projects have been getting scaled back from their original scope of what they wanted to do, or maybe the timeline's being extended as to when they'll be fully operational. And I think NEOM is probably the highest profile project they have, and that's been pushed back a bit from where the original plans were to where it's now. I think it's instead of being 200 kilometers, they're focusing on 50 or 25 now.
Yeah.
And they're going to develop that first and build everything in sections, which from a construction standpoint, you think that is a logical way to go. Instead of trying to build all 200, you build bit by bit by bit and gradually grow, not try to build everything all at once. But I think the budgets that MBS and his team have put out to do all this development to make Saudi Arabia a tourist destination, a more modern economy, it does cost money. And if you don't have the oil revenue to back up the construction revenue, you will have a drag on your economy because you're going to use debt.
Yeah, look, and it's not just that as well. It's I think that what the Aramco have got to do, as biggest company in the world, and a huge now trading presence globally, is that they've got to be seen that they're adapting and that they're dynamic enough to move with market when they drop market share. We wrote something the other week about China's Saudi crude nominations have finally rebound. Let me just share my screen a second. I'll show you this. Let me share my screen when you can. The world's top crude oil importer nominated around 44 million barrels of Saudi crude for August loading, and that's up from 39 million barrels in July. So that's a significant jump up, and I think the market will look.
You should be able to share that now.
Well, participants will look more and more at what will happen with how quickly Saudi move if they've lost market share. We're not going to talk about the TMX pipeline, the Trans Mountain Pipeline expansion project in Western Canada. We've spoken about it before. It's not a significant disruptor, but it's a change. It's new flow. The vast majority of those barrels are going to go to Asia. That could it's a different grade, but Saudi have got to be seen to be as moving as dynamic as a market wants them to.
Well, I would disagree. I think TMX is a big disruptor because when that gets up, right now it's been running at around 300 to 350 kbd. When that gets up to 500 kbd, that's a significant flow of oil of the heavy sour variety, which puts definite impact against Saudi's exports.
Yeah.
So it does provide a competition, and it's a competition because the lead time of that supply into the major demand market is shorter than what the Middle East to China would be. And so when you have that logistics push, it ends up being an equalizer against the flow that's larger but longer lead time versus the smaller flow with a shorter lead time.
Yeah, I agree. I mean, look, I want to get onto that because there's a few bits to pick here. But I think this is really what the market is looking at, We always said, and we're a bit cynical as old men that we are, that the market being so complacent to rely on Chinese demand growth is a waning argument, is one that is being sort of ebbed away the more that China becomes a mature economy, not a growth one. People are looking more at the India's and your Brazils and South Africa's and whatever it might be, and East Africa growing, and we've always banged that drum. But inventories is really what the market has looked at. And when you saw the GDP growth came in weaker this week, market was, risk off. And then you got the Trump argument. We're not going to talk about that this week, I know, because you don't want to, but it's fine. Let's see what happens. But his running mate is anti-China and extra tariffs, more about the US. there's a lot to pick there, and that's probably a whole separate podcast we need to put together. But when you are still talking about Chinese demand growth, you're really looking at inventories. And look, the market has long been reliant on, okay, there's sort of a big draw on inventories, and we touched on that a few weeks ago. A big draw on inventories you saw here, and slowly it started to ramp up. And you can see if you extrapolate this chart, okay, we're not going to get to the 2023 levels, but we're starting to cross into that area there where, okay, it's not substantially lower than the last 3 or 4 years, what they've showed us. This is my colleague Mu who put this together. But yeah, look, it's one the market is still looking at. I'm just not sure it holds the same weight.
I don't think it holds the same weight because you have to look at the internal Chinese demand as a reason why do they hold that amount of crude stocks. I mean, much has been written and much has been reported about the increase of EV penetration in the Chinese market and how that's been hammering down demand for gasoline and distillates.
Yeah.
And they're pushing forward with that, as well as in their energy conversion of electricity production. Yes, they have the coal-fired plants, but they also have a fair amount of solar, and wind that they've also put into place, green energy. And all that's contributing to a lower demand profile for China, lower consumption profile. Therefore, maybe they cap out at around this 960 million barrels level, which they've been at many times in the past. And that becomes kind of like the new ceiling of their economy as to what they can support from a crude stock level. Because they don't.
Yeah, I agree. Look, I think with China, right, if we're going to focus on that this week, because you don't want to focus on Trump. No, I was going to make a joke then, but I'm not going to because we're serious and it's too early. Okay.
This is not a political podcast. This is your favorite oil energy podcast.
It depends. If Democrats do better, you'd have a different argument, my friend. But anyway, we're not a political podcast. But I just want to touch on something here. Okay. People are looking, if you look at the optics of China, they are a consumer, the world's biggest oil importer. I think the market should start looking at things a different way. Okay, people are buying more Chinese goods, not necessarily your toys, your Barbies, other dolls are available. You've mentioned there about the EV market, and there was an interesting stat yesterday that came in because we've spoken about this before. When I was in Singapore, I'm in Singapore routinely, and I'm on the roads here as well. The number of Chinese-made cars and vehicles that are on the roads has exploded, over the last 2 years. Not literally, I mean in terms of the number of vehicles. Last year, the Chinese car manufacturing industry, now they've got all their massive showrooms down Sheikh Zayed Road, all glitzy and lit up and look great. They were about 2% of market share 2 years ago. Last year, or whatever they took, I think they take it up to the end of June, 13% they've got market share now. That's an extraordinary jump. And you're talking about your Toyotas, your Lexus, your Mazdas, your Infinitis, your Nissan, these big conglomerates out of Japan that are bought by the big families here, like Alpha Tame and our Gargash and all those kind of guys, done very well. They must be looking over their shoulder now and thinking, okay, how do we compete here? Because they are 25 to 30% cheaper, the Chinese. Is that how people should be looking at China? By the things they're producing and how people are buying them rather than what they're consuming? Or is the market that naive that they're just thinking, well, people will buy it anyway. I'm worried about, I want to sell them coal. I want to sell them iron ore. I want to sell them crude oil. Because I think that shift is happening, and that has proved itself by the car market here in the UAE.
Well, I think the car market is probably more a result of that activity. And yes, I think the dynamic of China, I think people are still looking at it from an old paradigm, not a new paradigm. People are still looking at China, analysts are still looking at China as if it is a super growth economy. It's going to be the absorber, the consumer of all commodities, and therefore bullish China, bullish China, bullish China. And that's the underlying sentiment you see in the analytical reports around oil demand, since we talk oil here. Everybody points to Asian demand, Asian demand, Asian demand. And forget the OECD, forget Europe, forget United States. It's all Asia focused. And that story has probably come to an end, and people have yet to realize it because they refuse to accept it. I am a believer that peak oil like it or lump it, we're probably in the midst of peak oil demand. And people won't realize this until 3 or 4 years down the road, 5 years down the road. But this 102, 103 million barrels a day of consumption is probably the height that we're going to get to, mainly driven by substitution of EVs or other type of power sources and efficiency gains that have been happening across the industrial spectrum for the last 10 to 15 years that have been pushed due to regulatory changes on emissions and environmental rules being put into place in certain markets around the world. Because even China has been doing their fair share of environmental rules and regulations, capping emissions, reducing their production of CO2 gases or other polluting fuels, polluting emissions into the atmosphere. And so when
You know how you don't want to talk about Trump, right? I don't want to talk about peak oil demand. Okay, so can we just have we just have that agreement? No, no. Look, I'm not cutting you off. I agree with you, but okay, the whole argument changes. And I know that we're going to have to go to a greener environment and save the dolphin and get it right, blah, 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 blah. But when the price of something becomes so attractive that a manufacturer or a consumer of that energy source has no alternative, and I'm throwing here to natural gas, right? Let's say, okay, the green argument, I know this is right in your wheelhouse, Edwards. People say, okay, all my ships are going to run off ammonia going forward. All my ships are going to run off methanol. But when gas is so much cheaper and you can lock it in, a long-term deal, you can lock it in. That's good for business. It's good for economies. It's good. Okay, it's better for the environment. It's not where we want to be in terms of renewables or the big plans. But don't you see the focus shifting away now, less from the environmentally sensitive to the cost sensitive?
Well, I think those arguments have always been there. Because at the end of the day, we're all here to run business, and sustainability should not be a case where the ability of your business to function becomes exorbitantly too high because you're trying to meet these certain requirements. When you look at the about face that's been done by major shipping companies here in the last couple of weeks, shifting from methanol into LNG as a fuel source, you got to start asking the question, why is this going on? Because at the end of the day, the ability to produce pure green fuels relies on the ability to produce green hydrogen. And green hydrogen is hyper expensive to produce in the current technology that we have. And you can't get economy of scale to the point where green fuels start coming down to be more cost competitive to petroleum-based fuels, because the trillions and trillions of dollars, not only in the infrastructure around the electricity production to make green hydrogen happen, but also in the handling, the blending, and the other processing facilities required to be built to make the green fuels happen, and then the logistics supply chain to move those green fuels into a market where they can meet the shipping demand. That's a huge investment chain that's going to take years to develop and years to make happen. Where I think the more quicker, elegant solution is, somebody's probably going to come up with an exhaust gas scrubber that's going to capture the majority of the CO2, the majority of all the other pollutants, store it on the ship, and then deliver it to a shore facility for processing. That's where I think the world is probably going to come to an engineering solution around how do you cut emissions from the maritime industry without developing an entire green fuel profile for methanol and ammonia. And I think the recent about face of shipping companies coming out of methanol go into LNG because it's cheaper, it's more prevalent, it has a supply chain, and it does reduce your emissions. Not as good as methanol, but it does, as green methanol, but it does reduce your emissions. It shows that there's that cost factor that's coming into play that has to be thought about and dealt with, because if you're relying on a government subsidy to support your industry, your green agenda, i.e. through tariffs or through taxes, you're basically an unsustainable market or unsustainable product.
Yeah, look, I mean, I think this is
Let
a
me
really
get off my
interesting.
soapbox.
No, you're right. I think this is a really interesting subject, and get in the comments below, because I think that this could be a sort of separate podcast, not still a smoking barrel, but a separate episode that we can run, because I think, look, I've covered fuel markets for 15 years. I've heard the renewable argument, and I'm not being dismissive or ignorant here at all. I've heard the argument so many times, and I do think, actually, and you make a couple of good points there, you always do, Edwards, No, you make a couple of good points here, seriously, because I think that we're coming to the end of the line where people are like, okay, let's stop talking about this. Let's just stop. Loads of meetings and loads of conferences and blah, 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 blah. Everyone's flying around the world to do the very thing that they should be doing, which is reduce emissions. I think that we're getting to a point now where owners, ship owners, and the whole supply chain, port authorities, ship agents, lighteries, whoever it may be, as part of that. I think people are getting to the point now where we're like, right, my chips are going on LNG. They're not going on something that is much better for the whale and the dolphin that hasn't been invented yet. I need to actually make a decision. LNG is where it is. I can lock it in supply-wise. The infrastructure is there. It's not there everywhere, but I think then what you come into your second point, which is I think scrubber technology moves on. Scrubber technology for the uninitiated is a system where you can run a higher sulfur than 0.5, which is the worldwide emissions on fuel oil, and you can capture the high sulfur fuel oil, which is 3.5%, still burn it in your engine, and you're not upsetting Johnny Polar Bear or your mate
there's a few issues with the closed loop versus open loop scrubber. The majority being the open loop scrubber, and you're still dumping sulfur impregnated, ash impregnated wastewater over the side of the ship. You're not keeping on board you're not processing it in an offshore facility or whatever. But nevertheless, the scrubber technology can advance and probably will advance, and that's probably where investment dollars should go, because at the end of the day, even if we get into greener fuels, petroleum is still not going to go away. It's still going to be part of the mix. Even when you look at the BP full green adoption, I believe they have oil demand dropping to 65 million barrels a day, 70 million barrels a day, roughly. So you're only seeing a 50 million barrels a day drop with full implementation of Green Agenda 2050.
Yeah.
2050.
Just maybe go back to the scrubbers, right? Because I'd like to be the voice of the people. We're not professors like you, Edwards. When you say they get the closed loop system on a scrubber, then goes to a processing unit, say offshore. What does that mean? Because if you're naive and you're like, well, they're probably just burning it anyway when it gets to port, it's been incinerated and the sulfur dioxide gets emitted anyway. What this processing? Tell us in a nutshell what that is.
So basically, you end up with you have two different types of scrubbers systems that were developed during the initial phases of IMO 2020. You have the open loop and the closed loop. Open loop scrubber basically means you're bringing in tons of water, pushing it up to the top of your emission stack, washing the emissions, and then putting that same water back over the side of the ship. So there's very little retention, very little holding, but it is going through the ship. It's an open loop with the ocean. A closed loop system, you have a set of water that's on your ship that remains on your ship, and it still gets pumped up through the stack, comes back down, but when it comes back down, it's retained on board the ship. It's gone through a bit of a processing on the ship where a lot of the waste is taken out, so that water can be recycled and used again.
Okay.
And the waste is basically put ashore where it's dewatered and probably sent to landfill, or it's used in other things because it's basically a combination of ash and
Hang on. So I just want to get this right, because I feel like a doofus here. No comments. Don't comment on that, anyone. A scrubber is seen as environmentally friendly, but what you're doing
wait. I would not say it's seen as environmentally friendly. I think it's seen as a mechanical implementation to solve sulfur emissions.
But if the same crap is going into the atmosphere or landfill or into the ocean, poor dolphin, just a moment, tuna friendly, what's the point? It's just going, instead of going up there, it's going in here and over there.
Well, you're bypassing a rain cycle that would normally happen, right? So instead of having sulfur dioxide mix in the atmosphere, become acid rain and drop in the ocean, you're just putting material into the ocean.
So you're just doing it, and you're doing it quicker instead of it raining.
Well, it may be quicker, and I'm not a chemist, and I'm not a professor. I just know that the material goes off to the side, and that's why you see a lot of countries looking to ban the use of open loop scrubbers within their international waters, because they don't see the environmental friendliness of this type of system. So the closed loop scrubber, you're basically controlling the emission, and you're still controlling the processing of the waste, And then from that processing of the waste, you can probably use it as a fertilizer or something else that can actually be beneficial because it's a ash and it's there's
Right.
probably other things that can be pulled out that can be recycled and used again.
Look, I know you're not a professor. I know you're not a chemist, but you did a bloody good job of trying to be one then. So thanks for that. I just think it's, you know, the whole sort of objective of this podcast, me and you talking about stuff in the market, is to try and make it a lot more relatable and people can understand. And that's like having a conversation down the pub. Not that we go to those.
No,
Um,
never.
no. But it's a really interesting subject, isn't it? And you know what's going to happen, sulfur emissions going forward, technology, natural gas. People read it, kind of go, "Oh, look, another nat gas story. Oh, look, another solar story." And I just think a lot more context needs to be put around it, which you've just done. So thanks very much for that. But it was a good question at the same time. So thanks, Dan, and his shirt. It's important to kind of discuss. And I think that the market now is becoming, I read the other day on Bloomberg, I think it was, that the ESG drive is kind of coming to an end. You know, this environmental, social governance, whatever it is not kind of as preeminent as it used to be as a driving force. And I think that that's been reflected in what's happening with energy as well. You know, people seem to be a lot different now in their sort of outlook is, okay, yes, I know we've got to worry about the future, but I need energy, right? So let me buy some now. So I've got some, and then I can talk about what we'll do in the future rather than people kind of panicking as they used to be a couple of years ago. Do you
Well,
think, do you agree with that?
I think ESG has been embedded now in a lot of companies, and that's where it becomes less of a story because a lot of publicly traded companies now have ESG as part of their overall ethos, as part of their operation, and even
Right.
privately traded companies because it's become demanded by banks, demanded by investors. Therefore, it's now part. And once it becomes just part of the standard language, it never becomes something you focus on because it's there. It's kind of like
Right.
the same thing with the ISO 14,000 compliant, and now I'm ISO 19,000 compliant. That used to be a big deal, but when everybody has it, it's no longer differentiating. Just like ESG. Once everybody has ESG as part of their social bylaws, it's no longer differentiated. They're all following the same profile. So therefore, it doesn't become something that you want to look at because it's not differentiating you.
Right. Okay. So it's embedded
But
now. Okay. But it's baked in the cake is one of our.
But I think the other piece coming back to the scrubber story, the emissions and everything else, is that I think when you had the big push of green fuels and ammonia and methanol, and oh my God, we got to really do something. And you had the confluence of the IMO coming in with their rules, the EU coming in with the ETS and the Fuel EU Maritime, which kicks off next year. On top of that, you had the invasion of Ukraine by Russia, which called natural gas to go through the roof and put energy origination and energy mix well into the focus of the general population
Yeah.
because it contributed greatly to the inflationary impact that everybody had across the board. I mean, when you had people whose home heating bills on the offset of the invasion went from 200 euros a month to 5,000 euros a month, which is anecdotal stories, but that's kind of the impact of the nat gas spike that happened.
Yeah.
It does put energy consumption, energy mix well into the front and well into the foray of what we're doing. But now that the world has normalized a bit when it comes to the market prices and how everything's kind of interacting, we're kind of in a state of normality. Now people are going back to, well, do I really want to keep pushing this green fuel, which I can't really get the pricing that I want because none of my customers want to pay for it.
Mm.
And B, does this inflationary impact of going down this green agenda path, which is massively inflationary, as a government, do I really want to keep pushing this as hard as I was before? Because I really want to get reelected next year. Therefore, how much value do I have in keeping this strong forward green agenda on the books?
Yeah. Look, I mean, I think that's a very good point. I mean, God, it's soapbox. You've got to get a ladder on that today, haven't you? Uh, anyway, no, look, that's a very good point. And can we just bring up our favorite containerized freight index, please? Because
Oh,
I
but of
think
course.
I think you're right. I think is the market, the world accepting? You know, we've got two major conflicts going on right now, and arguably the implications for a wider conflict within the region. I'm talking specifically here, Red Sea, Iran, Iraq, Saudi. We don't want to put too much hyperbole around it all, I suppose. And then Russia, Ukraine, and what's happening. The world has gone to election. Is the world accepting that that's just the way things are? And I think you're right. I think that maybe people have, the way that people view how they get their energy, how it's shipped, the routes it has to go, the people who are shipping it. I just think people have become a lot more aware of it, and I think that's why the markets have settled. I think, and you can kind of bring that back into the prism of what the containerized freight index means, because we've seen that plateauing recently, right?
Yes, no, it's plateaued here in the last couple of days. It actually come off a little bit from the highs. It's still strongly elevated. So it's still going to be impacting producer price index numbers coming into a lot of countries that are receiving containerized goods. Consumer goods will continue to be strong and be supportive because all this pricing will start leaking into the overall price of goods over the next couple of weeks. I think it should start impacting things here now.
Yeah.
Perfectly honest, this is how these things kind of lag or lead into inflationary environments. If you look at the inflation numbers that came out from the United States, there was a bit of a cheer that, oh, look, the overall inflation number went down. But the core inflation, which excludes food and energy, went up.
Yeah.
It was only up 0.1% month on month, but it was a upward move. And that's the thing that this type of container freight index, when its container shipping has gone that high and that cost structure starts getting passed through, it will show up in inflation.
Yeah, I mean, look, my colleague Reed, he's our senior macroeconomist we've got at Kepler. And he said yesterday, be careful assuming too much from June CPI figures. While the recent disinflationary trend could prompt a rate cut in September, be careful extrapolating too much. It is likely that a much weaker labour market will be needed to get inflation back to 2%. We are also expecting oil to exert some inflationary pressure in July. I think you're right. Look, I think that there's lots to take away here. The market has priced in 100% that there'll be a rate cut in September. I'm not 100%, but I'm probably 80%. I think that the big takeaways there from our favorite containerized freight index, it's up 100% since January the 1st. It's up 275% year on year. Tankers have steadied.
Well, actually, tankers have come off, so we are seeing a lull in the tanker market.
Oh, yeah. Okay. So, I mean, look, I think that the key thing here to look at is, since the noise has been around what Powell's going to do, what the Fed are going to do, inflation's coming down, other things within the energy sector, apart from flat price, because I think they're still pricing in a bit of war risk premium. But I think with the supply chain freight, with that coming down, I think that's very much reflective of a macro sentiment.
Yeah, I would agree. I mean, I think the demand is not as strong as some people would want to make you believe. And that's being reflected in price action. That's being reflected in supportive action, such as freight moving lower. And I think that's going to be a story that as we get through. I mean, when you look at the EIA data out yesterday, 8.7 million barrels a day of gasoline demand in July, which should be holiday weekend. Now, some people are saying, "Oh, that's because Hurricane Beryl killed off some demand." Well, okay, that might have impacted some Texas demand, but Texas is not the entire United States. It's a part of the United States.
Well, it depends who you talk to in Texas.
True. But they are their own country in some people's minds. But nevertheless, the fact that gasoline demand is still averaging just below 9 million barrels a day for a summer season tells you that the gasoline market has peaked in the United States. It's not going any higher.
I said I didn't want to talk about peak oil demand. You don't want to talk about Trump. We've covered.
Oh, we can talk about Trump, but it's just, is Trump bullish or bearish oil markets? He's probably more bearish than bullish because he's going to open up oil drilling in the U.S.
Look, we're going to get onto that later on in the year. If we start now, we'll talk about it till the 5th of November when it's it's election time. But look, 85, where are we closing now? 85.60 on Brent seems to be the number. A couple
Range
more
bound.
range bound. A couple more episodes before we close out for the summer break.
Potentially one or two, but yeah, I think summer break's looming light bright upon us, and so I think that's going to be definitely we'll probably have one or two here in July, and then be back in September.
Okay, mate. Well, look, good to see you.
Good to see you as well, and thank you all. Click like and subscribe. Shout out to our producer Irene.
Yeah.
She works hard and helps us very much and keeps us all together, keeps us our level of sanity in place. So thank you much, Irene, and
Yeah.
look forward to seeing you all about town or about different conferences or industry events.
Ciao.